All right, what is up, guys? So today we're going to be talking a little bit about what not to do in markets, what indicators to stay away from, what kind of traps that people typically fall into, especially newbie retail kind of traders. Really, let's just jump right into it. The first kind of thing when you start trading, you're appealed to technical analysis, right? Drawing on chart, putting squiggly lines on a chart, doing trend lines. You have to be able to differentiate the objective analysis, what's actually happening, and the speculative analysis. Hey, what do I think might happen? Or what do I think is actually going on behind the scenes kind of thing. So here's just an example. Really quick example is, objectively speaking, this chart is headed to the top right corner. Right? Even a 4-year-old knows that we are trending towards that top right corner. A 4-year-old knows that this is headed to the bottom right corner. Right? We can use indicators or anything along those lines to get an idea of that happening. But what ends up happening is people will start to draw trend lines all over the place and somehow make it seem like this is actually a bad thing. This is actually bearish price action. If you take an intra trend line, this is a bearish retest of that trend line. So here's just one example, and to get you on the right kind of wavelength as to the rest of this video, a lot of trading and figuring out what to do is actually found in figuring out what not to do. So trend lines are a very exemplary kind of case in that manner. So you typically want to stay away from things that are incredibly subjective and speculative. So here's an example. We turn off the Doge price action, and instead we're just going to start drawing trend lines all over the place. So we're just going to draw them willy-nilly. I don't even remember what the price action looks like, but we're just going to start drawing and drawing and drawing. And when we turn price action back on, you are going to start to see whatever it is that you want to see. So this trend line that I drew is suddenly support, 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 resistance, 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 and it's currently acting as resistance. Wow, oh my gosh, that trend line is so alpha, except for it's not. It's literally, I drew it blind. So that's just one example, right? So how do you know that your trend lines are alpha? I know I'm hurting a lot of people's feelings right now because a lot of people use trend lines, but I'm just trying to prove a point. It is incredibly subjective. You have to know that you are speculating, and that's not necessarily a bad thing either. The fact that you're willing to speculate and not just simply subscribe to, oh, the number's headed to the top right corner, so that means that's all it's ever going to do. It's just going to continue to go to the top right corner. That means that's why the market exists. Right? The fact that you are willing to speculate and go against the trend, against the herd, that is the entire premise as to why the market exists in the first place. It's just that when you first enter trading, you enter markets, the first thing you hear is 95% of traders lose. So then if everyone is doing the same thing and everyone is using the same tools and speculations and feels the same emotions typically because we're all human, how am I able to approach the market the same way as 100% of people and 95% of people lose? I'm approaching the same way as them, but I'm trying to yield a different result. Isn't that like the definition of insanity or something? So let's keep going down this path. The best way to figure out what to do is in figuring out what not to do. This does not just simply apply to something as simple as trend lines. So let's take the same exact kind of thing and apply it to candlestick trading. So, okay, this is a macro kind of a top. This is a Pico top. That candlestick, all these wicks on the top, those candlesticks imply we are headed lower, except for the same exact candles occur over here, and they occurred all the way. Let's go back into this bull market. They occurred over here. We really didn't care about them. It occurs right here. We didn't care. It occurs right here. We didn't care. Wait a minute. So then how are you able to tell me that, oh, this candlestick is different than that candlestick, even though they're the same candlestick? And I know that my examples are not the greatest, but for every single candlestick that you find me that implies a bottom or a top because it has a crazy wick on the bottom or whatever it may be, whatever your reasoning is, I can find you 3 or 4 more where it doesn't do exactly what it implied it would do. So that means that is a false positive consistently. 3 out of 4 times, maybe 4 out of 5 times, it is a false positive. It is implying something and it does not go on to do that something. And here's the tricky part. When it doesn't do that something, so when a wick on the top implies a top and it doesn't end up being a top, that's what ends up happening. So the times that it isn't correct drastically outweigh the times where it is correct, and you're able to catch a top, buy back lower, and now you're a genius in making money in markets. That's not really how that works. So you're actually applying a losing strategy, something that is very discretionary, very subjective, and very speculative, and simply does not hit more than it misses. So if that's the case, that means that the underlying alpha is the user. And anyone who uses candlestick trading will tell you this. They're not being offended by, oh, I'm making fun of candlestick and candlestick traders. They're not getting offended by that. They fully understand that they themselves have to differentiate why this candlestick is different than the previous one. And then that kind of discretion in context is able to provide value to them in their own portfolio. Here is the tricky part, man. All these retail traders, especially newbies and beginners, they fall victim to vanity, absolute vanity, things that are not bringing you value. Oh my gosh, that has a wick on the top, and so therefore it must imply this, and then it doesn't do that. Consistently making losing arguments and losing time and time and time again, and then being vindicated on the one time that that argument is finally correct. That's not really how we want to work. Instead, we kind of want to respect trends. We want to do something where it rewards us maybe 17 times in a row, and then the time that it loses, it really doesn't matter because we've already drastically overcompensated for that inevitable loss that will come eventually. So something like a trend that will always break. Every single trend breaks. Every single uptrend is met with downtrend. Every single range must eventually expand and turn into a trend. These are just simple kind of statements. They are inevitables. The market will always do this to some degree in some way, shape, or form. The only thing that ever changes is time and price. So you kind of have to think about it like a UFC fighter or a boxer. If someone is undefeated and they're 20-0, you probably are more likely to bet that they're going to win their 21st fight. They've already won 20 in a row. But in the back of our minds, we understand that the longer this streak continues, and we can't continue putting the inevitable at bay. Eventually, if this boxer or UFC fighter continues to fight, eventually they're going to be out of their prime, or they're just not going to have a great day. They're not going to get a lot of sleep that day, whatever it may be. And they're going to take that loss eventually. So it's probably in their best interest to retire, as they're coming down off of that peak. Quit while you're ahead kind of thing. The inevitables will always occur, but it really doesn't matter if you bet on a boxer to win and they end up losing if they've already won 40 fights in a row and you've been winning because you've been betting on them to win all of their previous 40 fights prior. So it's the same kind of thing. And it's so unfortunate that people fall victim to the exact opposite, where they're consistently focused on the fact that that fighter is eventually going to lose, and they're preying on that person's downfall. You're drawing trend lines in hopes that trend line is going to act as a Pico top so that the trend can finally reverse. You are trying to make arguments as to why this candlestick is different than that candlestick, which was no different than that candlestick, which was no different than that candlestick. And then finally you're right, and then you get vindicated, and oh my gosh, suddenly you're a genius. We haven't even broken down to where the point where you would have started making those arguments as a pleb candlestick trader. So you have to be able to dictate when not to use your system. A really good example of this is going to be RSI. Really quick, I just want to give a shout out to the sponsor of this video, Coin Market Manager, the lead journaling and analytics tool for crypto traders. Connect an exchange account via read-only API for fully automated imports, saving you hundreds of hours of manual data entry. Analyze your trading habits in just a few clicks and improve strategies with data-driven insights. Link in the description below. So now we're on the Bitcoin chart. We have our RSI up, which is just simply relative strength index. A lot of you know what this is. I don't think I've ever made a video on this because I don't use this indicator, but it's a pretty popular indicator. I would say it's probably one of the most popular retail kind of indicators out there. Now, the issue is that when you're using RSI, typically what you want to look for are divergences. So places where price action is doing one thing and the relative strength index is doing the exact opposite. So the way that you go about finding these divergences is by looking for places where price action finds a higher high, and for example, the RSI finds a lower high. So that then creates a divergence between the two, between price action and the relative strength index. The issue is it can continue over time. As you see, the relative strength index continues to put in lower highs, and it's only when we come back 3 months later and after a 40% rally, of which that indicator has now finally triggered and it has finally done at exactly what it implied. So that means then that you're wrong, 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 and then finally, 3 months later down the line, you are right. And here's the thing. You being right doesn't even bring you back down to the point where you started to make this argument in the first place. It gets you about halfway. Then we find a high time frame bottom and we reverse and continue the uptrend all over again. So in hindsight, all you had to do was turn the RSI off, have the comprehensive ability of a 4-year-old and say, that's headed to the top right corner. The probability is that it's going to continue heading to the top right corner. So the alpha there was not the RSI indicator. That was not it. It actually hurt you more than it helped you. The only way that it would have benefited you is if you had some kind of discretionary way of being able to differentiate why this divergence is going to be respected, whereas all of the previous divergences were neglected. I am a firm believer that if you start to adhere to this kind of way of thinking, then you can drastically mitigate how much you are consistently losing in markets, and you can find yourself on the right side of trends. It just so happens to be that we are human and we are fearful. So when we're in an uptrend, even if we're properly positioned for that uptrend, we tend to find arguments and seek out reasons as to why our success is going to come to a halt. So the proper, quote unquote, kind of way to use RSI would be actually to look for bullish divergences in an uptrend and bearish divergences in a downtrend, something that is coinciding with the objective stance in the market. And that way we can give ourselves a higher probability of actually benefiting from those insights. And if we want to be contrarian and use RSI as a reversal indicator, then we need that kind of way of differentiating why this time is different, whereas the previous times where they were false positives technically were exactly the same trigger as what we were getting here. So to sum it all up, the edge in discretionary trading is your discretion, but it's your discretion in the form of knowing what not to do. I really do think that if you focus harder on what not to do and stop focusing so hard on what to do, you will actually align and find your way along what you should be doing. Now, this is all pretty basic information. It's pretty bare bones, but it is generally applicable to the entirety of the market. Any indicator that you might use, anything that is even remotely speculative in nature, or requires your subjective discretion to differentiate why this trigger is any different than the previous trigger. So with that said, thank you guys for watching the video. Really quick before I go, I do have a free Discord. The link is in the description below. I give daily market updates every single day in that channel. Also, I have a private Discord of which you can find more details about in the free Discord. But really, all you need to do to sign up to that private Discord is use either my Bybit or my Femex referral link, which you can find in the description below. You can get access to 3 live streams a week, daily market updates, and my trade concepts and ideas in real time. Regardless, I do hope to see you guys in that free Discord. I hope you enjoyed the video. Much love and take it easy.